Welcome to the Perspectives on IBC series, where advisor Chris Tormey joins me in a discussion on all things related to the infinite banking concept. In this educational series, you'll learn the basics of IBC and how you can recapture the financing function in your life so you can gain more control and freedom of your wealth. So welcome back. I'm here with Chris Tormey for the third episode of our series here on the foundations of IBC, the infinite banking concept. And so if you're listening, you've probably heard the first couple we've done, and really centered on understanding what is IBC, how does it work at a fairly high level. So hopefully, if you haven't listened to that, I urge you to go back, listen to those, really chock full of great information that Chris and I share around kind of the basics around IBC. And so one of the things we want to, and we did introduce the concept of what product underlies this whole sort of process and system. And it's a whole life insurance policy from a mutual insurance company, right? And so we wanted to share a little bit more about it. And what a lot of folks typically do to help sort of show this are called illustrations. And if anyone who's gone through insurance quotes and looked at illustrations, and you've got lines and numbers and a lot of legal language, it can be daunting for anyone to absorb. So we're going to spare you that today. Maybe in another episode we'll get into it, but if you're with advisor, you're going to see this. But we want to just give you a sense of what illustrations are, like how they serve the purpose in terms of the conversation, and then show you more of a high level sort of structure of what these whole life policies look like, and we'll kind of give our take on it. So Chris, first off, thanks for joining me back again. Really, really great to have you on and leverage your wisdom and experience here. So, tell me, what, from an illustration perspective, tell the listeners, like, what is that really? What's kind of the background on illustrations, and what is it and what isn't it?
Sure. Thanks so much, Tom. I'm happy to be here and look forward to this conversation. So the first thing everyone should know about illustrations is that when an advisor or an agent is working with you on a whole life policy or any permanent life policy, you will sign off on that illustration and say essentially that it's been described to you what is in that illustration. So it's a requirement on the part of agents and financial advisors to share an illustration for a policy that we're looking to engage in with our clients. So you will be asked to sign there. And as you pointed out, what it is an illustration, so not the truth, but it looks out from present day. So let's say a 40-year-old all the way out to the end of their life and beyond. Typically, an illustration will go all the way to 121 years of age. So in that example, 40 to 121, 61 years of columns showing numbers. And there's a lot of numbers. But two of the columns look into the future and gauge cash value under two different scenarios. The first is guaranteed cash value. So there's a premium that gets paid in. That's required. And required is in a little bit in scare quotes, because once you build cash value, you can definitely take a year off of paying a premium, but it's paid for by the policy. So it is a required premium. And the cash value will grow based on guarantees. So at least a certain number that the contract has built into it the year that you buy. And those guarantees stay solid for the entire period of the rest of your life or the rest of the time you own that policy. And the guarantee essentially is there in case dividends cannot be paid on the policy. And as we've said before, I think in a prior conversation, for most of the mutual insurance companies we use, there's never been a single year where no dividend was paid, reaching all the way back to Civil War and Depression and World War I and II and so forth and so on. So right there, the guarantee is not reality, because it shows every year over the next 61 for that example, no dividend announced, and there's never been a single year where no dividend was announced. And once a dividend is announced, you've got a new guarantee because you've got new money introduced into the contract, and that new money from the dividend, assuming that your dividend is not paid to you, but rather put right back into the policy or staying in the policy, that now is subject to guarantee as well. That's called a paid up addition to life insurance. The second column is the constant dividend column as part of the illustration. So that shows that the 2022 dividend will stay that exact same number. So let's say it was 5.75%. It'll be that exact same number for the rest of the 61 years of the policy. So also a completely unrealistic column, but one that shows you sort of like, if every year were like this year, this is what it would look like. And that 5.75 that I mentioned, that's not what you're going to gain in your cash value, because first, beneficiaries have to be paid off from deaths that occurred that year. And the business itself has to be supported, from the buildings to the labor to the technology to the compliance they do to the loans they administer and so forth and so on. But you are the third level, and that's why we like mutual insurance companies, because there is no dividend to pay out to a shareholder before you as the policyholder get your money. So those are the two vital columns for cash value growth. Neither will play out, but both are instructive to show you what the insurance company, how they pay over time.
Yeah. But however, though, there is a contribution amount, the premium, there is a guarantee, that guaranteed sort of section of the illustration. It says, if you put this amount in, you're going to have a guaranteed at minimum cash value and a guaranteed death benefit, right? Even if you get zero dividends, that's essentially the floor, right? On the types of policies we're designing, right? If you get no dividends, right, you contribute this. This is by contractual obligation. It's a legally binding contract between you and the mutual insurance company. You pay this into it. You're going to have X in cash value and X in the death benefit to your beneficiaries if you passed at minimum.
Yes. You have a whole host of guarantees that they've given to you, and your obligation is to pay those premiums. That's basically what you're telling the insurance company you'll do. And then they have a whole host, we could get into some of the others, but a whole host of guarantees that they're providing to you. But the one is pay the premium that is in that illustration, and everything else that they promise to us will play forward at a minimum, and maybe perhaps better.
So tell me, Chris, dividends, obviously we know they're not guaranteed. However, they've been paying them for the companies we're using well over 100 years. So the expectation is pretty high that we'll receive them. You'll receive them as an owner of these policies. But what could affect how high or low they are? What's going to change that?
Well, you're in a partnership. You're in a partnership with a huge portfolio run by professionals in portfolio management called the general account. And the general account at the insurance company is where the lion's share of your premiums are going. A portion goes obviously to beneficiaries, just like it would for term life insurance. But the balance, the rest of it, and virtually all of your paid up additions are entering into a partnership with a general account of many, many, many billions of dollars that invests in the markets. And it tends to invest in liquid assets that are from large companies and governments, real estate, and financial institutions. So areas that these insurance companies have a lot of expertise in, and those assets will produce coupons, will produce capital gains or losses in some cases, will produce dividends for the general account, all added together per year produces that dividend that's announced once per year. So once per year, a dividend is announced by all the insurance companies. and that dividend is then held to for the next 365 days. And once a year, a loan amount, if you are going to borrow some of your cash value, is announced. And so everything you borrow that year and everything you've already borrowed prior will be subject to that new interest rate. And that's just once a year, which gives, and those are guarantees that they're giving as well, once a year and then held to that for the year. So you've got a lot of stability there that you can really plan around. It's not like something changes every day like you see in the stock and bond markets, that we go into with our retirement accounts or with our brokerage accounts.
Right. So it's fairly conservative portfolio, right? Pretty safe stuff. They're going to hold just by sort of state regulations, certain amount on reserve, right? Pretty significant amount, way more than what a bank would typically hold, let's say, right? They're going to hold a substantial amount because they have a lot of potential liabilities people pass, right? So they need to have that available. And obviously because they're investing in a lot of, fixed income type of products, right? So interest rates can cause some changes, right? In those valuations we've seen, like we were talking before getting on here, like if you had a policy from say 15 or 20 years ago, right? Times when interest rates were higher and we've gone through a significant period of very low interest rates, you can see that the dividends in a lot of cases will be lower than what was originally projected back 15, 20 years ago. Is that what you're seeing too, Chris?
Yes, exactly. Yes. So I think by and large, you could say they track somewhat the 5-year corporate interest rate. So a 5-year treasury right now is about 4%. So corporate bonds tend to be 2 percentage points, 1 percentage point more than that. And that's where that 5 3/4 comes from for these insurance companies. And yeah, 20 years ago, the illustration, not the guarantee, but the illustration of constant dividend might have shown 8% or 8.5% going all the way out for those 50 or 60 years, including the year 2022 and 2023. As it turned out, the dividend reported in 2022 was not that 8%. So in that case, the illustration of constant dividends was a bit on the optimistic side. Now, we're of the belief that perhaps we've reached the bottom of a 40-year interest rate cycle. We came up from 1940 to 1980 from really close to 0% to about 20% in interest rates in 1980. 1980 to 2020, we came down from those high teens pretty much to zero during the COVID year. And, now they're higher. Are they going higher for the next 36 years? I certainly cannot tell you that, but they are nearer to the bottom than they have been to the top over the last 80 years.
Yeah, and we always have to remember too, outside of just what's happening in the markets, because we are a member of this mutual insurance company as being an insured person, that we are part of a profitable company. These companies have been around for a significant amount of time. And so as part of that, part of the dividend is just the sheer nature of being part of a profitable business. And we know how important that is and that how great that could be to, invest in a company that is profitable and understands how to run a good business. So that's a part of why being, part of a mutual insurance company is a core portion of this.
Yeah,
this
I'd say profitable and also extremely efficient. So their management team, is running, let's say, $50 billion worth of general account assets. And it's all managed towards the same goal of providing dividends and beneficiary payouts. So you don't need a huge team. You do need a very talented team, but you don't need a huge team that you've got to pay those big kind of Wall Street numbers to. And that really makes the efficiency of the management extremely good as well. So talented partnership with a really good cost to asset ratio.
That's wonderful. And so, as we go through when you go through with Advisor, if you ever get down this path of looking at illustrations, right, you're going to look at some numbers and hopefully recognize, like Chris and I are talking about, they're not all going to be exactly the same in the future, right? You just got to know that going in, understand philosophically and strategically how this works. And so the next stage is we're going to walk through a just a little flow here. It's a illustration of an illustration, right, if you will, or a policy, just to give you a flavor for it. And so for those who are listening just on via podcast, we'll try to explain this in a simplistic way so you can understand it. If not, I would urge you to go check it out on the video side, because we're obviously recording this on the video side as well. But what I'm going to share is just a concept that I learned years ago from one of my mentors. And I thought it was really an easy way to illustrate this. So imagine your whole life insurance policy is like a funnel, right? You're funneling money into it through the form of a premium, right? That's your contribution every month, just similar to like a mortgage, right? There's a premium amount, and it's actually guaranteed never to go up, your base premium. And for that, you're putting in premium every month or year based on how you wish to contribute. And it's building up what we talked about, cash value, right? That's also guaranteed a certain amount, right, by contract. And that guaranteed cash value grows tax deferred. That's in the shell is tax deferred. And if treated properly, you will never pay tax on it if you understand how this works. Right. The other guaranteed component of this is the death benefit. We affectionately call it the lifetime payout. Like when you pass, there's a death benefit that is also guaranteed as part of this contract and illustration. And that will pass tax-free from an income tax perspective. And depending on where you are, it likely will be estate tax-free as well, unless you have higher levels of net worth in your estate. Now, what is not guaranteed is what we talked about before, the dividend. And that dividend, like we said, had been paid for well over 100 years. We expect it to be paid, but we can't guarantee it. But when the dividend coming back, one option is to put that back into your cash value, right? And we'll talk there, you're buying a little bit more insurance, right, through that. And so that adds to your cash value, right? And now that sets another floor as a guaranteed amount. So you're increasing that guarantee by the dividend that comes through, and you're buying more insurance, right? And it's a cash value is growing. And so that over longer periods of time can generate this 3.5% to 5% internal rate of return in these policies. So that's why we look at this as a safe asset, not an investment, right? So this is the type of tax deferred growth you can get in a vehicle like this all along the way over long periods of time. Now, throughout the course of your, for IBC, obviously you want to start using these dollars, right? Now and certainly in the future. Now, in the future, you probably wouldn't want to do this early, but you can literally withdraw money from your cash value, from your policy. It's an asset you own. So you can withdraw, and the unique nature of these types of policy designs is you could withdraw up to all that you contributed first, right? And so then that all comes out tax-free. It's your contribution. And then the second part, which is all the gain that you've amassed in here, comes out in the form of a guaranteed loan that comes from the life insurance policy. And that's primarily what most people are going to use early on if they're going to use the IBC policy for investments, for purchases, whatever. That's the form you're going to use, and leave your cash value sort of continue to grow, right? So that you're just using it as collateral in that way. One of the last things I want to share, and this kind of hits on maybe the dividend part, is there's a unique sort of rider we can add to these policies, and there's different ways to design them, but and each company may have a different approach on how they do this, but you have an option to contribute more cash into your policies outside your base premium. And a lot of these are called paid up additions, and they may have different names for them, but essentially what you're doing is you're infusing more cash into these policies to buy more insurance that builds both your cash value and death benefit. And again, builds up more guaranteed dollars, right? Every dollar you put in here, it gets guaranteed, it does not lose by any market fluctuations. So in this scenario, you're able to build up more cash early. And that's kind of one of the magical parts about some of these designs is that's how we do that. The paid up addition portion is really helping to generate short-term savings that you can deploy faster. And the premium that is a guaranteed really long run is really long-term savings that will build up over time. And the combination really can be powerful over the course of the life of these policies. And lastly, I just want to share that there are other benefits that come with it. You'll see these as part of illustrations, but they're kind of other pieces of it is that there's a disability waiver premium. So if you get disabled, that they'll continue, the life insurance will pay this on your behalf, right? The premiums of the policy. There are, for most states, and you have to be state specific, but most of them are protecting the cash from creditors. So that's a really big benefit. There are some that provide protections against chronic illness and long-term care needs, using your death benefit while you're alive. And as we mentioned before, that some of it can pass through to your heirs or beneficiaries estate tax free if done strategically through different types of legal entities like a trust. So that just gives hopefully a flavor of kind of the core moving pieces within a policy. And then when you see this from other advisors, you're going to actually see numbers tied to some of these things. And so it's just important to kind of know kind of the working mechanics of it. Chris, anything you want to add to this?
It's a great schematic. I hope that people can get to wherever they can see this as well as hear it. The one thing I'd add is, and we have talked about this before, your base premium is going to contribute very little to cash value in the early couple of years, but tremendous death benefit value right off the bat. Not as much as term life, which gives you maybe 1,000 times the death benefit to the first year premium, but something like 100 times. So you put in $10,000 and it's worth $1 million death benefit. The paid up addition sort of is the opposite, where $10,000 of a paid up addition might buy $20,000 or $25,000 or $30,000 worth of death benefit. However, that $10,000 in paid up addition premium gives you nearly all that amount, let's say $9,500 of cash value immediately. So the combination of the two really makes a powerful financial instrument for you. So that combination of PUA and base premium is really what brings the power that we see to IBC, to infinite banking concept. And again, we'll get into the meanings that we read into what Nelson Nash did when he named it IBC, infinite banking concept. And a big part of that is those paid up additions that really give you early on access to capital to make the investments or cover those emergencies that you may need, that so many people are relying on banks to provide to them, which pay no interest and perhaps have more risk than it feels like at the outset when they make that deposit.
Yeah, no, that's great, Chris. Yeah, so hopefully this was helpful. We wanted to at least give you, we in future episodes might go into some other details around some illustrations, but we want to just give you a high level view of the structure, some of the kind of key components of it, and so you can get comfortable with it. And yes, like we have always said, it's the product is the whole life insurance policy from a mutual insurance company, but really this is about the process and the strategies around it. So we want to make sure that you're crystal clear on how that fits into it, right? And know enough to understand how the policies themselves work as you're discussing this with your advisor. So any last party shots, Chris, with this one? We'll end this.
Yeah, I'd say the process and the partnership. I love having a partnership with a very, very powerful partner that has my best interests in mind, a mutual life insurance company and a giant general account that can really dictate so many things around investments and returns and wealth growth. So I love the partnership and I love the protections that they're providing us with those guarantees.
Well said, Chris. So thanks for joining us. We'll see you on the next episode, number 4 of this series, and we'll see you back then.
Thanks so much, Tom.
Take care.
Take care.
Thanks for listening to this podcast, and hope you're enjoying this series on the infinite banking concept. Next up is Part 4. Why is it called the infinite banking concept? In addition to the podcast, I would highly encourage you to get the book, Becoming Your Own Banker by R. Nelson Nash. If you want to discuss how IBC can enhance your financial life, feel free to book a free call with our team. We'd be more than happy to help. Visit perennialpride.com to book your call.